Hi, I'm Darius Dale, Senior Analyst on the Hedgeye macro team. I cover Asia, Latin America, and emerging markets. And what I wanted to talk with you today about is our emerging outflows theme. So if we look at a chart of the US dollar, let's go back to the beginning of the year. We thought US growth would stabilize, US growth would then accelerate, and that would be positive on the margin for the US dollar, which is what we see in this chart. Now, if we look at a chart of US interest rates, we also thought the expectation of interest rates rising over the course of the year would effectively lead to a tightening of global monetary policy, which we've seen. And historically, that combination, strong dollar plus rates rising, has been very bad for emerging markets, and it's led to capital outflows from emerging market economies. So where to from here? How do we play this? So I think there are three scenarios that investors need to be mindful of as it relates to emerging markets from here. Number one, status quo. U.S. growth expectations continue to accelerate and remain elevated, and we continue to see outflows from slow growth, yield chasing, commodity related emerging market type asset classes. Number two, U.S. growth slowing actually. Broad risk aversion. Investors are fearful, and obviously that would very much impact emerging markets to the downside as well, along with a lot of other asset classes. And in scenario number three, which is also a high probability scenario, U.S. growth slows at the margins and the Fed gets more dovish at the margins. And that's something historically we've seen to be supportive for emerging markets, yield chasing plays, commodities, et cetera, et cetera. So as it relates to which securities and asset classes you need to be in from here and how to play it, we think here are some long ideas or some things to overweight in your portfolio. At the asset class level, we continue to see outflows from fixed income markets into equity markets globally, and we think the EM ETF is poised to be a relative winner here. At the regional level, we've done a lot of proprietary factoring work on ranking emerging markets from a risk perspective and a crisis risk perspective, and we thought that emerging Europe, of all the regions, had the best, most healthy metrics. And thirdly, at the country level, we like Mexico, Poland, Russia, South Korea, and Taiwan. Each of those countries has great balance of payments / external dynamics. They all have political stability, and one of the things that Mexico and Russia in particular have going for them is an exposure to crude oil, which is sort of the last of the Mohicans in the commodity market. And flipping over, as it relates to short ideas or things you should underweight in your portfolio, at the asset class level, we continue to see outflows from fixed income markets, and we think that's going to really weigh on local currency debt. That's the EMLC ETF. There's a lot of illiquidity in local currency bond markets, and there's a lot of spread risk remaining in the currency market broadly. Number two, at the regional level, we think Latin America is poised to be a relative loser here, and it has been, and we think that shall continue. The GML ETF is the ticker for that, and one of the things that's specifically a headwind for Latin America more than the other economies is this exposure, its broad exposure to the commodity complex declining. And lastly, at the country level, we dislike Brazil, Chile, Indonesia, Thailand, and Turkey. Each of these countries has poor or deteriorating balance of payments dynamics, potential political instability, et cetera, all the bad things you don't want to see in your portfolio at the end of the year. And so with that, please tweet me. I'm at Hedgeye D Dale. Again, emerging outflows, we think it continues from here, but we also think there'll be relative winners and relative losers. And have a great weekend, everyone.